Yeah, I'm losing my
About
edge.
return on your trades, though, and trying to optimize that return here today via trade size, Mikey. This is something that I think it takes a lot of traders a while to get the hang of. Similar to a lot of more states, even in the last couple of weeks here, legalizing sports gambling, and a lot of people who like jump to this weekend. We got the big game going down, and it's this scenario of like, all right, I just don't downloaded my sports gambling app, or I just downloaded my stock picking app, or my trading application, and I'm just kind of spraying out money left and right. It's just like, oh, I like this opportunity, that's $100. I like this opportunity, that's $100, and this and that and that. And you're just kind of like measuring things willy nilly, and then you get a feel for your strategies, and then you kind of maybe subconsciously get a feel for how much you want to be betting, or you never actually get a feel for how much you want to be or should be betting. And so I want to dive deep into this conversation, this topic that is seldom talked about, because everybody wants to go straight to where's the opportunity, what's the fun thing to do, and it's seldom referenced how much you should be betting or trading in terms of size.
Yeah, it's an important consideration to make in trading and in life. How much resources you're going to allocate to a certain strategy. I think it's kind of the underdog of metrics to consider is your trade size. I mean, do you just go all in? I mean, you see people now like, oh, I put everything on Tom Brady winning the Super Bowl and it paid off. But how do you allocate those funds to hedge and create a well-rounded position? I think it's an important consideration.
Absolutely, man, and yeah, whether it's Tom Brady or, I mean, as recent as this week, this last 2 weeks, I want to be a part of the GameStop AMC Silver Dogecoin, whatever. Which you, at some point, I'm going to sit down with you and you're going to explain to me what the hell Dogecoin is. That'll be. Am I even saying it right?
Yeah, Doge. Some people pronounce it doggy, which I'm okay with. I mean, the emoticon is a dog, so whatever. That can be widely accepted. It's actually one of the most highly transacted coin, even though it doesn't really mean much. It's like a meme coin. But
we'll go into doggy coin at some point. But either way, it's a matter of that. Like, I want to be a part of this, and I think a lot of people, for better and then for worse, and especially this week, were like, oh, I put too much into this. Like a lot of people who, hey, if you doubled, tripled, quadrupled your money at one point, GameStop up over 1,000%, then yeah, it was a smart thing to put all of your account size into that. But then on the way down, it's like, oh man, I just got my whole account size cut by 70, 80% here. And so it's a matter of, today we're not saying this strategy is right, this strategy is wrong. It's just a matter of allocating those resources in a way that you can sprinkle stuff on all strategies so you get diversification, but you're not too deep on one thing over the other. Before that, though, I want to give a little bit of a precursor, because in futures, Mikey, and we're settling on this for most of today's conversation, which is 50-50 bets. It's kind of like you said there. Am I betting on the Bucks this weekend or the Chiefs? And with the line that's involved there's a theoretical 50% chance of both of them winning. And so it's a matter of, when you have these 50-50 bets, Mikey, getting that edge in your favor so that your success rate is better than 50-50 on whatever strategy you're looking at. And we're going to hang on that word edge for a lot of today's segment. And then defining losses, which we've done a lot of segments on in the past. Go look in our archives for on segments on taking losses. But that is also hugely important when you are doing these 50-50 bets. And it's funny, because this is something where I would actually contend that gambling has a better system than trading, which is, when I go to bet on the Super Bowl this weekend, Mikey, I can say I'm putting $5 on this, or I'm putting $50, or I'm putting $5,000, and that's defined. That is how much I'm going to make or lose. But you go into futures, and I just wrote an article for next week. When you, for instance, sell a future, your maximum loss is infinite, theoretically. Of course, like a market, that would be some kind of system, and maybe Wall Street Bets, this is the next thing to see if that infinity can actually be reached to the upside in some market. But same with the downside, not infinite, but like if I buy a futures contract, Mikey, I'm not able to, in the current structure of markets, just say, hey, I'm just going to lose $50
Mhm.
and I can kind of step away from this bet and let the market play out. That's defining loss is very important for that reason, right?
Yeah, I agree. And that's kind of the importance of different order types, right? Is like you can kind of set
Mhm.
that, but it's not embedded in the product itself. And the other thing, too, Frank, is like with the ease of just buying and selling futures, there's no cost to borrow necessarily as there is with short selling stock. That's kind of work against you if you're holding
Yeah.
a short stock position. Futures just as easily buy, just as easily sell, which kind of helps even this out, make it a little more 50-50. But controlling those, here we're looking at average profit, average loss, is really going to help normalize everything.
Absolutely. And so that's the groundwork now to jump into the conversation of picking a size because to me, it's all based around that edge piece. Like taking losses and all of that, that's like mechanics that I think every trader, from my point of view, every trader should have that baked into everything. Like I don't think that's something that shifts back and forth. I hope that you really take a look at taking losses in futures trades and build that into your mechanics. But when it comes into choosing a trade size, that is something that I feel is a little bit more dynamic. And for today's example, I want to look at interest rates, and they've been moving around a lot this week. And we love here at the Small Exchange the small yield product that moved through its projected high for the week, which could provide a slight edge to shorts. Now, Mikey, when I look at a short term trade in here and I say, hey, there's a standard deviation on this week. The market moved past its upside standard deviation. I see an edge in the market that selling into that outlier move to the upside could pose me instead of a 50-50 play on any random day here to buy or sell this market. Now maybe I've got 5% or 10% in edge to this market coming back down into where it was supposed to live. That's kind of that's an example of the edge that we're talking about here today. And it's the same with long-term trades as well. You know, this is something that is very close to my heart here, which is mean reversion in the long term and normalization in interest rates. Looked at this earlier this week. The average 10-year interest rate, Mikey, is north of 2% for the last 10 years. And so I think there's a little bit of an edge in long yields here in the long term, banking on the fact that this market has lived in this range of 2 to 3%. Right now it's sitting around 1%. And so this market should climb to $20. That's what we're talking about when we're bringing 50-50 bets to gain some edge in your favor.
Yeah, it's always nice when you can kind of zoom out and look at more of the medium, longer term trends here, because it looks like we're just getting started if
Yeah.
this were to be a continued rally in interest rates. But been having watched this the last few days, the last few weeks, I'm thinking, oh wow, interest rates are really above 1.1% on 10 years. Like that's pretty rich. And we've done research before on the elasticity and the mean reversion of interest rate plays, and maybe going against the grain on a shorter time frame sometimes works, sometimes it doesn't. But I think it's nice here. You can kind of set your bias basis your time frame.
Exactly. And you can also, and this is more meant to not be like, oh, here's an interest rate trade, and Mikey and Frank just made me sell interest rates, and then I just bought it, and now I'm flat, and there's no, this isn't a segment that we're talking about, a strategy that we really like employing this week. It's just two good examples of creating edge in two different time frames, two
Mm-hmm.
different strategies at the end of the day, because this is what we're really working with here is 50-50 trades with greater perceived edge should use a greater percentage of a portfolio. And here we have this goes back to I was inspired by this from my old days of probability theory at University of Michigan, where you have there in the square, I don't even, what would you call that, like a beige, a taupe?
Yeah, I think beige is suitable. Maybe like I don't know, some kind of clay, perhaps.
Oh,
Test it out.
Clay. Thank you, Michael. But there you have, 100% of your account size, whether that's $1,000, 10,000, $100,000, that's all of your money there. And the way that we distribute these things, say we have just a bunch of 50-50 trades across different products, across different asset classes, and everything else. They're all 50-50 trades. The ones that have a little bit of edge, Mikey, I'm going to commit 5% of my portfolio to churning out that strategy on a daily and weekly basis. Those ones like we just got to that second one there in interest rates, where I would say there's probably considerably more edge in that market coming back to where I have decades of statistical context for. That is a larger edge trade that I would probably say, okay, maybe I'll put on 2 or 3 or 4 units to that long S10Y position for the long term. And I know I'm going to hold that for a little bit there. And since I have maybe a smaller edge in this short term, the market broke out of its projected range and I think it's going to come back, maybe I do one, short unit in S10Y. And these are all just examples. You can kind of do this for yourself, but I just want to at least lay the foundation for greater amount of edge, greater confidence in a trade paying off, greater percentage of account size. And this is why a lot of people, Mikey, start with, I've got a clean slate, 100% of my account is at my disposal here for trading. Where am I going to start? Well, probably long stocks, just like put a core piece of long stocks. Why? Because the perceived edge in that 50-50 trade over the last several decades, since we started tracking stocks a century ago, is higher, higher, higher. And that edge is probably, over, if you get the time span long enough, that edge is more like, I don't even know, like 80-90% chance that your stock that you buy today will be at a higher amount in 10-20 years. And so it's all a matter of the amount of confidence, the amount of edge I perceive in a trade translating to the greater percentage of my portfolio.
But what's so important here too is looking at beige and gray and near black. None of them are 100% of your portfolio. And I think that's the biggest thing. If you have like a 51% edge or even an 80% edge, it just doesn't make sense to dump everything into that, because you look at the average return on some of those trades, you're going to have some losers, you're going to have some winners. Net, maybe you're making more money in an 80% edge strategy. But if you dump everything in, then you could be wiped out completely. And then you're off the sidelines, you can't trade anymore. That's never fun. So the big thing with position sizing for me is to always be comfortable with how much you're putting in. Even if the edge is there and you have strong conviction that it is, just don't go all in. It doesn't make sense.
Absolutely, because why do you not put all of your capital into, okay, in this example, I have 2 trades. One of them has a 5% edge and the other one has a 15% edge here with a 65% success rate. Why wouldn't I just say, screw this worse strategy? It's got a worse edge to it. I'm going to dump everything into this trade that wins 65% of the time. Well, you still could lose that 35%. And if you go, this is like the theory of like one big bet as opposed to a bunch of different sized bets. If it doesn't hit in the next week or the next year, the next decade, it is that 35%. Well, you just lost the whole thing. This is like where you make fun of the fact that like, oh, Tom Brady this weekend, he's a sure bet. Like you should take out a mortgage and put everything into it. Even if the market is mispriced and there is an edge in buying Tom Brady, he still could lose. It's nothing is ever 100%. We know that.
Yeah. You can never capture anything and everything under the curve. There's always, GameStop was a crazy outlier. Like, who would have knew? The guys who were short there. But then, the other thing too is like, you're out completely, you're off the sidelines, you can't participate anymore. If you make it big, like we've heard that story before, it's a great story, but it's a story because it doesn't happen. You're much better off playing a little bit of the math, constructing a holistic portfolio, spreading your money all throughout in different strategies. They'll offset each other, create a little more balance. And I think it'll help overall with your consistency in trading.
Absolutely, man. Great points there because yeah, it is this it's this struggle. I feel it. And you probably feel this too. Every once in a while you get this jealous
Yeah.
thought when you read that social media post where it's like so and so made $100,000 on one trade and it's like dang, if I just did that once, like I would be rich. And it's like, yeah, but what you didn't read is for him the 99 stories that said so and so lost their full $1,000 account size on
Yeah.
one trade. And it's like,
And they
yeah,
didn't close when they were profitable, and then they lost it on the next one.
this
Yeah.
thing is just like it stinks, but this is why people follow our program and why there's such a push for retail traders to be more involved is because it's hard. It's a
Yeah.
little bit harder. Like there is no one trade and then you go away. Like even with GameStop, even if you did hit it big on GameStop or AMC or silver on the upswing, you took your profits, you're probably coming back because hey, this is work. This is being active. This isn't one big trade and then I go sit on a beach somewhere. And so with that in mind, you have to chop up this trade size and diversify those strategies and make sure, even if it's something that does not look that good or interesting on a Monday morning, if you know that the edge is in that strategy, you got to commit that smaller trade size, even if it's a few percent. And then when you see your strategies that have larger edge, you commit a little bit more of that account size to those strategies. I know a lot of people do high probability options trades and futures scalping.
Hmm.
This is exactly what we're talking about. If you have a greater edge in those options trades, a bigger portion of your account size goes to that. And same with a smaller amount going to these 50-50 bets and futures that you push to 55-45.